Okay, so in this chapter we'll be talking about rental property and flow-through entities and royalties, most of which will be applied towards Schedule E of Form 1040. So let's begin talking about rental property. That'll probably consume most of this chapter's discussion today. So income and expenses from rental property, as I said, are reported on Schedule E of Form 1040, and we'll talk a little bit about what is an ordinary and necessary expense as it relates to rental properties and the deductibility of those expenses. So we've reviewed ordinary income and expenses before. Ordinary expense is an expense that is what we expect would be incurred in the rental of real estate property, such as maintenance of the property. So the IRS code defines these as customary or usual. Rental property is depreciated using a straight line schedule, and rental property is depreciated at 27.5 years straight line, and non-residential, or what's commonly referred to as commercial property, is depreciated over 39 years. We only depreciate the structure and furniture only of depreciable real rental property. We don't depreciate land. Land is never depreciable. So if a person is engaged in the business of renting real estate, then that would be reported on Schedule C as a regular business. However, for those who have other primary types of income, but may have a few rental properties that they use to supplement their income or plan for retirement, then that income and the expenses relating to that, the generation of that rental income, would be reported on Schedule E. If a tenant is renting your property and provides value to you, the landlord or owner, in another form, such as by providing services, then that is included as rental income and has to be reported. So Brady owns a rental property that he rents to his friend Jack for $800 a month. In November, Jack repairs a leaky roof for the rental property for $450 and pays Brady $350 for rent. Well, Brady would report $800 of rental income, the $450 for the repair, and then the $350 for the cash payment. So this gets a little interesting. How we categorize income that's received on the rental of vacation homes depends upon how much we rent that property out and how much we use the property for personal use. So there are three categories then. I'm going to go back a minute. Primarily rental, primarily personal, and a personal rental. So one of the best ways to really understand these three categories of rental of vacation homes is to kind of go through some examples. So Jose owns a vacation home. He uses it over Christmas for 7 days, and then he rents it to vacationers for 90 days. And so this property will fall under one of those three categories. Jose's home is primarily a rental property, and that has implications on Schedule E, which we'll talk about later. It's personal use. The taxpayer or family or non-family may use it free of charge. So there's no rental charge to be levied against a friend, for example. Then that would qualify as personal use. If you spend time working on your property and doing repairs, this type of work is not considered personal use. Now these are the tests then that we use to determine which of those three categories applies to the rental of a vacation home. It's used no more than 14 days for personal purposes, or 10% of the rental days, whichever is greater. It's considered primarily rental. And therefore all income and expenses of this kind of property would be reported, as I said, on Schedule E. When expenses are shared, let's say you have a vacation home and you have property taxes levied against that vacation home, and you use it partially for rental or partially for personal purposes, then you would allocate that property tax against the rental income for that proportional part of it, and then the rest would be applied on Schedule A of Form 1040 if you itemize deductions. We're going to talk a little bit about losses that are sometimes allowed or often allowed for lower income earners up to $25,000. But they are subject to these passive activity loss rules, which we'll expand on shortly. So they're primarily rental homes. Mandy rented her home in Laguna Beach, California for 190 days for $36,000, and she used it for 17 days. Well, if we look at the rule of 14 or 10% of rental, this is clearly a rental, primarily a rental property, because 10% of 190 days is 19, and that's greater than 14 days. A home that is rented for less than 15 days but otherwise used as personal residence is primarily personal property. Excuse me. So primarily personal property means that if you earn any income from renting out a vacation home that is categorized and qualifies as primarily personal, then you do not have to report that income. Sometimes during the Masters golf tournament, folks may rent out their home during the tournament to others. They just vacate the home, and they can command a very high rental for golf enthusiasts who want to watch the tournament down in Georgia. And so they'll leave their home rented out, make some good money, but because they rented out for less than 14 days, it's considered primarily personal, and they don't need to record or report that income on their taxes. So an example of a primarily personal home, Maya rented her cabin in Big Bear for $2,000 for 10 days over the holidays, and she and her family used it for the rest of the year. Well, this would be primarily personal since it was rented less than the 14 days. Then there's this hybrid, this personal and rental category. And so if the rental property is used more than 14 days for personal purposes, or 10% of rental days, whichever is greater, and rented for 15 days or more, it's considered personal rental property. And as before, all income and expenses are reported on Schedule E, and then there has to be an allocation of shared expenses. Any expenses that are directly related to the rental of the property, like advertising to rent the property, then those direct expenses would net against the rental income and would not, of course, be allocated. It's only the shared expenses, like we said before, property tax or interest on the mortgage for the rental home, that would be allocated and shared. All right, so let's go through a couple of examples here. Darren rented his home at the lake for 48 days for $9,000 and stayed there on weekends with his family for a total of 18 days. During this stay, he worked to replace the roof for 6 days while his family went out on the boat. So now we have to consider the fact that we have rented this property for 48 days and stayed on the weekends for a total of 18 days. And then he worked, as I said, to replace for 6 days. So let's look at this for a minute. Darren's personal use is only 12 days because those 6 days repairing the property, that, as we said earlier, does not count as personal use. That's referred to as the rental use, or related to the rental of the property. So if you take the 18 days the family stayed there minus the 6 days that the owner spent working on and repairing the property, then Darren only stayed there 12 days. So, as I said earlier, that working on the roof does not count as personal days.